The fallout from the failure of SVB hasn't resulted in a cascade of collapsing banks, but it has panicked investors and consumers alike, as well as forcing the government into issuing many assurances to asset holders. Let's assume the worst. If the banking sector was threatened because a run on the banks was initiated, we would see contagion, with one bank collapsing after the other. This would spread outside of the tech sector, exposing other banks to instability. Companies would lay off as many employees as possible to save on costs, while households would spend less and less, and we would enter a recession. For now, the signs are still pointing towards stability. While inflation in major economies continues, many of the forces behind it have been halted, and there have been no major changes to consumer spending, employment, or growth that could signal that quantitative tightening has had an undue impact on the economy. This isn't universally true, but it was true enough that the European Central Bank decided to raise interest rates again by half a point on the 16th of March. This brings up another concern, that central banks might be too focused on fighting inflation. If that were to trigger more bank failures, it could very well be too late to stop the panic train from leading to systemic collapse.